Hey everyone, welcome back to the channel. So you're ready to get into real estate investing, but you're hearing a lot about something called a 1031 exchange. What's the deal with that, right? Is it some kind of secret tax loophole, or is it something only real estate moguls know about? Well, good news, it's not a secret. And no, you don't need to be a real estate guru to understand it. In this video, we're going to break down the 1031 exchange step by step, from what it is to how it works, and how you can use it to supercharge your real estate investments and avoid paying tons of taxes. If you've been thinking about leveling up your real estate game, stay tuned. We're going from beginner to pro in the next hour. And by the end of this video, you'll understand why this little-known tax strategy can make you a lot more money and help you grow your real estate empire faster. But before we dive in, make sure to hit that like button, subscribe, and share this video with anyone you know who's looking to start investing in real estate. Trust me, they'll thank you later. All right, let's start with the basics. What exactly is a 1031 exchange? It's named after Section 1031 of the IRS tax code, which allows you to swap one investment property for another without paying capital gains tax on the profit. In simple terms, you can sell a property, make a profit, and instead of having to pay taxes on that profit, you can use the money to buy another property. It's like deferring your taxes until later, all while growing your real estate portfolio. It's kind of like getting a tax break, but instead of spending the money on things like that new gaming system or maybe a fancy vacation, though I mean, those are definitely tempting, you're actually using it to build your real estate empire. So, imagine you bought a house for, say, $200,000 a few years back, and now it's worth $300,000. Without a 1031 exchange, when you sell, you'd owe taxes on that $100,000 gain. But with a 1031, you can swap that property for another one of equal or greater value and avoid paying taxes. Boom, instant tax relief. Now that we know what a 1031 exchange is, let's go ahead and talk about how it actually works. There are a few key rules you need to follow, so buckle up because this is where it gets, well, a little detailed. First, the property you're selling must be an investment or business property. That means your primary residence doesn't qualify. You can't sell your home and buy another home using a 1031 exchange. That's called personal property, and the IRS doesn't like that kind of thing. So if you're selling a rental property, commercial building, or land, you're in the right category. The key is that it must be held for investment, meaning you intend to earn income or appreciate in value from it. Once you sell the property, you have a specific time frame to identify and buy a replacement property. Here's where it gets tricky. You have 45 days to identify potential replacement properties and 180 days to close on the deal and finalize the exchange. So, yeah. If you're thinking about going on vacation during this process, it might be a good idea to pack a laptop and keep an eye on your property search, because the clock is ticking. Now here's the part where people sometimes get tripped up. You must use a qualified intermediary. This is a third party who holds the proceeds from your sale and makes the exchange happen. You can't take possession of the cash from the sale. It must go directly to the intermediary. Think of this like a referee making sure the game is played by the rules. The intermediary keeps everything legally clean so you don't accidentally trigger a taxable event. So basically, if you're thinking about taking that $100,000 profit and buying a new car, forget it. The IRS says, nope, no cash for you. Now that we know the basics, let's look at some of the different types of 1031 exchanges. There are a few variations, but we're going to cover the most common ones. First up, the simultaneous exchange. This is the simplest type of 1031 exchange. Essentially, you sell your current property and buy a replacement property on the same day. It's like doing a quick trade-in on your car, except, with millions of dollars in real estate. Not really something you do with a used car, right? But this can be a great option if everything lines up perfectly. You sell and buy the same day, you have a qualified intermediary, and you don't get cold feet in the process. Next, we have the delayed exchange, which is the most common. With this option, You sell your property and have up to 45 days to identify your replacement property and 180 days to close the deal. This gives you a little more time to find the perfect property, but remember, the clock is still ticking. The reverse exchange is another option, and it's for the more seasoned investors out there. This allows you to buy the new property first and sell the old one second. Sounds a bit like a time machine, doesn't it? But you better be ready, because this one requires some serious paperwork and might be a bit more complicated. And finally, we have the improvement exchange. This one is great if you want to buy a property and use the exchange funds to make improvements on it. So let's say you buy an old commercial building for a great deal and you want to remodel it into a luxury office space. With an improvement exchange, you can use the proceeds from your sale to fund the renovation work. Pretty cool, right? You can buy a fixer-upper and build equity at the same time, all while deferring taxes. Now that you know the basics of how a 1031 exchange works and the different types, let's break down the pros and cons. The biggest pro is obvious tax deferral. By deferring capital gains taxes, you can keep more of your profit in your pocket and reinvest it into your next property. This helps you grow your portfolio faster. Plus, you can continue building wealth without getting slammed with tax bills every time you sell a property. Over time, you could defer a lot of taxes. It's like having a cheat code in a video game. Just keep moving forward and level up your portfolio without all the tax monsters chasing you down. But there are some cons to consider. First, you're deferring taxes, not eliminating them. So, eventually, you'll have to pay those taxes when you sell your final property, which can be a big hit. Second, you're on the hook for following the rules. Missing a deadline or not using a qualified intermediary can trigger penalties. And if you're not careful, you could end up with a tax bill anyway. It's like trying to win a game without reading the rule book. You might win for a while, but eventually you'll get caught by the tax referee. So, there you have it. The 1031 exchange is an incredibly powerful tool for real estate investors, whether you're just starting out or you're a seasoned pro. It lets you grow your portfolio faster by deferring taxes, giving you more leverage to buy bigger, better properties. Do you think a 1031 exchange is something you could use in your real estate journey? Drop your thoughts in the comments below. If you found this video helpful, don't forget to like, subscribe, and share it with your friends who are interested in real estate. You never know, you might just be helping someone level up their investing game. Thanks for tuning in, and I'll see you in the next video, where we'll be diving into more tips and tricks to grow your wealth and make smarter investments. Until then, keep investing, stay informed, and, as always, keep that cash flow